If you've been anywhere near the crypto markets lately, you know it has been an absolute bloodbath. But here's the thing, what we're seeing isn't just some simple correction. No, this is a perfect storm, a really chaotic mix of pressure from inside the market and huge forces from the outside world, all hitting at the exact same time. So let's dive in and unpack what is really going on. To get a sense of just how massive this was, just look at this number, $19 billion. That's how much money in leveraged positions got completely wiped out in a single 24-hour window. I mean, that's not a dip. That is a seismic shock to the entire system, and it hit millions of traders. And yeah, Bitcoin always grabs the headlines, but the real pain, the deepest cuts, are in the altcoin market. This quote from one safe blog just says it all, doesn't it? A staggering 95%. It shows you just how widespread the damage is. Pretty much no corner of the crypto world was safe. All of the selling has shoved the market into what the pros call a capitulation zone. Now, what does that even mean? Well, this isn't just people selling to take some profits. This is pure panic selling, where investors are just dumping everything, often at a huge loss, just to get out. It's literally the definition of extreme fear. And you know what? That fear is something we can actually measure. And this number right here confirms it. The Crypto Fear and Greed Index, which is a huge indicator of market sentiment, has tanked to just 18. Now, to give you some context, anything below 25 is considered extreme fear. So yeah, the psychological state of the market is absolutely at a breaking point. So just how deep is the damage really? The whole market is seeing red, that's for sure, but the pain isn't being spread out evenly. And when you dig into the data, it tells a really fascinating story. Okay, so check out this profitability snapshot. Even with its own 23% drop, nearly 70% of all Bitcoin is still in profit for its holders. But now, look at the altcoins, less than 20%. So what's the key takeaway here? In this crazy storm, Bitcoin is acting like a relative lifeboat, while the entire altcoin market is almost completely underwater. So we've seen the damage, but the big question is why? Why did all of this happen? Let's start peeling back the layers and look at the pressures from inside the market that cause the whole system to buckle. This is always the most important question in any crash, right? Who is mashing that sell button? And the answer isn't just one group. It's a powerful and toxic combination of a few different players all acting at once. We can pretty much break down the selling into four main camps. First, you've got the long-term holders who are finally cashing in and taking profits. Then you have all the brand new ETF investors who are getting, understandably, very nervous. After that, you've got the forced selling from leveraged traders getting wiped out. And finally, you have the whales, the big money, who are strategically shorting the market. Let's look at the data behind each one. First up, the long-term holders. In just the last 30 days, a whopping 815,000 Bitcoin that had been sitting dormant for ages were moved back onto the market. That is the single biggest wave of this kind of selling that we've seen since January of 2024. It signals a huge shift in thinking from some of the market's most patient investors. Next up, the ETF crowd. This number, just over $90,000, is the average price that all the new spot Bitcoin ETFs were bought at. So with the market price getting dangerously close to this level, you have a massive wave of brand new investors who are right at their break-even point. And that is a huge psychological trigger for panic selling. In this is where the leverage bomb really went off. A staggering 71% of all the forced selling, all the liquidations, happen on centralized exchanges. These platforms, with their super fast automated systems for leveraged trades, basically just poured gasoline on the fire, turning a downturn into a full-on crash. But here's the thing. This crash wasn't just a crypto-only event. The market doesn't exist in a vacuum. So now, let's look at the powerful macroeconomic forces from the outside world that really fueled this storm. It was really a triple threat. First, the Trump administration's announcement of a 100% tariff on Chinese imports basically reignited the trade war, which spooked markets everywhere. On top of that, money is getting tighter around the world, which makes investors run away from risky stuff like crypto. And finally, that whole idea of Bitcoin being a safe haven is really being tested, because it's been trading almost in perfect lockstep with falling tech stocks. Now, in the middle of all this chaos, something really fascinating has started to happen. We're seeing a clear split in the market. It's like a tale of two very different types of retail investors, and they have completely opposite feelings about what to do. So on one side, you have the crypto-native retail folks. These are the veterans, right? They've been beaten down by the FTX collapse, the meme coin craziness. They're tired, they're wary, and they're sitting on the sidelines. But then on the other side, you have what's called TradFi retail. That's investors from traditional finance. They are just now coming into the market through regulated ETFs, and they are still buying. So you have this bizarre market where the seasoned insiders are out, while brand new money is trying to survive its very first major storm.
So that brings us to the ultimate question. What happens next? Where do we go from here? And honestly, the data is painting two very, very different pictures for the path forward. The market is at a major crossroads.
From a technical charting perspective, things look, well, pretty grim. Analysts are pointing to this classic bearish pattern. And without getting too deep in the weeds, what these steps basically show is a market that tried to rally, failed, and has now broken through its key support level. The really crucial point is that this kind of pattern signals that the risk of a much deeper drop is very, very real.
So here are the two competing stories right now. The bearish case is that the scary charts and the macro headwinds are just too strong, and they're pointing to a potential slide down toward the $85,000 level. But the bullish case, which is argued by analysts like the CIO of Bitwise, is that a quiet, boring end to this year is actually a good thing. It prevents a crazy speculative bubble from popping and instead sets the stage for a much stronger, more sustainable bull run in 2026.
And all of this leaves us with one final provocative question. Are we watching a market in the middle of a catastrophic collapse driven by greed, leverage, and fear? Or are we actually witnessing a necessary cleanse, a kind of fundamental rebirth where a whole new class of investors takes the wheel, paving the way for the next big cycle? The truth is, that answer is still being written.